Now, let's compare with this lessee accounting for the capital lease with the bargain purchase option. Comparing this, the exercise one with the guaranteed residual value, the company has the bargain purchase option. That means the lessee will take the ownership at the end of this lease term. So we need to identify what is the depreciable years of the capital lease, the lease term or economic useful life. Okay, let me read this, the wordings. The 3 years non-cancelable lease initiated January 1st. Oh, again, this now, the payment is starting from the beginning, January 1st. So 3 annual, the $50,000 lease payment also starting from the beginning when the inception of this equipment. The lease can exercise bargain purchase option at the end of the lease term for $10,000. Fair market value 154 will compare this fair market value of the lease asset with the minimum lease payment calculation. Lessee's incremental borrowing rate is 10%. We don't have the other comparing the interest rate, so we'll use 10. And then we have also present value of 10% ordinary annuity, even though this the recurring payment starting at the beginning, but what we are given is ordinary annuity. So we have to convert this ordinary annuity factor into the annuity. How? The beginning payment is equal to annuity due, and then annuity due is calculated. Ordinary annuity factor times 1 plus the interest rate. Why? Because by multiplying this 1 plus the discount rate, we can take all the payments in the future, take back into the current time for 1 year. That makes this annuity due the ordinary annuity. So when we use this 3.4869 times 1 plus 10% will make this ordinary annuity the factor to this the annuity due factor. Okay. Depreciable years of the capital lease asset. Okay. How long years we are going to use? Right. Because this has the bargain purchase option, so the lessee will take the ownership at the end of the lease term. So don't have to recognize 3 years lease term to depreciate this capital lease asset. So we use now the 5 years. The capital lease obligation at inception. Now let's calculate. That is one of the important points. The $50,000 annual payment now times annuity factor. Ordinary annuity factor is the factors we are given. So 2.4869. But we have to convert this annuity factor, the ordinary annuity factor, into the annuity due. How? Just by multiplying 1 plus 10%. By doing so, we can take all the future payments by 1 year carry back, 1 year back. Okay. And then, because ordinary annuity recurs every end of year, but the payment of the annuity due recurs every beginning of the year. So we want to take all the payments that carry back, so that we can get the annuity due factors. Okay, by multiplying 1 plus 10%. Then the payment, the last year payment also. How to get it? Okay. Now we need to get this, the bargain purchase option, 10,000 times, we have the given factor 0.275, 1.5. So we have the 144,290, which is lower than this fair value. So we have to use this the capital lease obligation. Okay. Now the current portion we'll calculate later. So let's start this the journal entry. At inception, the capital lease asset and capital lease obligation. Capital lease obligation is now we are using 144, which is lower than the fair value of 145. And then capital lease asset at inception is the same. In the first of the payment incurs at inception. So the cash amount out, how much cash out? Right, the $50,000. By this amount, we should reduce the principal of the first payment by $50,000. Then 1 year passed. At the end of year one, we need to recognize the interest expense and the depreciation. Interest expense for recognition is for the lessee use the liability for 1 year. So how do you calculate it? Interest expense, the principal at the inception is reduced by the first payment, and now we put 10%, so 9,429 is interest expense, but we don't pay this interest expense yet. Every payment recurs every beginning of the year, so at the end of the year, for the purpose of the closing book, we need to recognize expense because we use this liability for 1 year. So interest payable until the payment next day, we need to record. And then depreciation expense. How do you calculate it? Okay, capital lease asset minus what is the residual value? Okay, $2,000. Then how long years? We do not use this lease term 3 years because the lessee company will hold this asset. That means that the company exercise the bargain purchase option at the end of the lease term. So divided by 5. So 28,458 is going to be the depreciation expense. We will reduce the value of this capital lease asset by recognizing accumulated depreciation. Okay. The second payment, very next day, how much is the cash? Right, which is the same amount, $50,000. Then this $50,000 should include the interest expense? No, because we already recognize interest expense, but we need to remove this interest payable because this payment of $50,000 include interest. Then by this CLO, the principal amount should be 50,000 minus 949. That is the principal reduced for the second payment. Again, this cash payment $50,000 is comprised of the interest 9,000 and 40,000, the principal amount, the CLO, the capital lease obligation. And then the year end, now we need to recognize exactly the interest expense one more time. We don't pay at the end of the year, we pay the beginning of the year. So interest expense, how do you calculate it? We need to get the principal amount, the CLO has been dwindling. So the interest expense should be the calculated actual principal amount of the liability remaining times 10% interest. So until the payment, interest payable recognition, and once the company uses this asset, the company should recognize depreciation expense to allocate the cost of this capital lease asset. So depreciation expense, how do you calculate it? The same amount because that is the state line allocation. So accumulate depreciation as well. Then very next day, now the company should pay the last payment of $50,000, and then at the end of the lease term, the company will exercise this bargain purchase option at $10,000. So the cash payment should include interest payable. Interest payable, how much is that? Okay, there you go. Already the recognized this 5,000 with interest payable. Now the company paid, then the company should remove this payable. Then this $50,000 also is comprised of the interest and the principal amount. So CLO should be reduced by the $44,000 of this principal. Okay, and then finally at the end of the year, interest expense. We have the interest expense here. Why? Because the company has the bargain purchase option, $10,000 remaining. This $10,000 will be the remaining value of this CLO at the end of the lease term. That's why we have the interest expense recognition. So CLO still remaining, even though the company paid the last term, the $10,000 is remaining. Okay, so that produced the interest expense. Don't forget that. Then cash, how much is the cash? Right, the exercise $10,000 of this bargain purchase option. Then that is also comprised of interest expense. Now, how do you calculate it? Once again, the CLO, the beginning balance minus the CLO, the principal reduced times 10%, the interest expense, the use of others' money, right? That produce interest expense. Then the principal amount out of $10,000 is $9,091. So those by recognize CLO 9,000, and then I can expect that the CLO, the value at the year 3, at the end of the lease term is going to be the 0. And then finally, the depreciation expense for the 3rd year is the same as the depreciation we recognized. So same recognition of accumulated depreciation with the same amount. So let's see, how do we present in the financial statement, the CLO? The CLO total amount, we started from this, at the end of the year 1, should be reduced by 50,000. Then the current liability section, the CLO, is going to be the next payment during year 2. So the non-current liability amount should be 53,700 or 19. That is the sum of this CLO to be paid next year, right? So let's just start from the last year balance, then we'll remove this. Okay, the current liability at the year 2 should be showing the next the payment for the next year. So this amount should be what? The CLO, this plus this. Okay, then okay, total payment, oh sorry, this should be reduced by the payment 40,571. So there's no non-current liability after the year 2003, so it should be 0. Okay, and then the current liability doesn't have anything because we've done. Okay, let me just show you why we've done. Let's just start it from exactly the same balance of the last year, because that is the beginning balance of the current year. So this current liability should be reduced by the payment of these two. So we don't have any current liability and current the non-current liability for the CLO, so there's no value in total. Then this equipment of the CLO starting from CLA, and then accumulated depreciation. Accumulated depreciation should be accumulated negative every year like this. And then the CLA should be 58,916. I can predict that this CLA will be the 10 will be, just give me a second, or $2,000 at the year 5, at the end of year 5. Why? If I put 2 more year, okay, then those should be the $2,000 is the residual value, $2,000. Because when we calculate this, the depreciation in the first place, the depreciable cost took the residual value away, so that the company can remain in this the residual value as the book value net CLA at the year 5. Okay, so that's the net CLA at the year 3, year end 3. Okay, that's all. Oh, by the way, we have to put this CLO, the current year portion is 40,000. Okay, so that's all. See you in the next video clip. Bye bye.